So welcome everybody. We will start. So first of all, for those who don't know me, my name is Didier Vandenberg, and I'm the Risk Underwriting Director of COFAS in Belgium and Luxembourg. I wish you a warm welcome at our webinar on the economic consequences of the Russian-Ukraine conflict. This webinar is part of our Trade Risk Academy, the channel through which we share our knowledge with you. We give tutorials. We give webinars like this one. We share publications. We also have pod talks, so you can see them on our YouTube link, which is below of the page. So of course this webinar will be recorded, and you will receive the presentation on PDF via mail. So this conflict is, of course, first of all a humanitarian tragedy, of course, with huge consequences for millions of people. But we can't deny it has also a big impact on the global economy as well. So my presentation is split in two parts. There's first is an overview on the macroeconomic consequences, and the second is the perspective of risk underwriting, and of course there at the end there's room for questions. We have muted your micros, so I would like you to ask to use the chat function and write your questions down. So let's begin. So my presentation on the macroeconomic perspective is divided in 4 parts, as you see. First, a short item on the fast deterioration of the situation. Second, short word on the sanctions imposed on Russia. Next, a larger part on the consequences on the global economy, and finally a word on the sectors which are impacted. But unfortunately, all sectors are impacted. But first of all, let me take you back to 2 years ago, when the COVID virus hit the world, first in China and afterwards in the whole world. It was an unprecedented shock for the world economy, and we all agreed a huge wave of disruptions and bankruptcy was coming our way. But the fast and the rigorous response of most governments and central banks helped to avoid a catastrophe by injecting huge amounts of liquidity in the economies, and by setting up all different kinds of aid and state schemes. It helped big time, because in 2021 the economies recovered, and in Q4 most advanced economies were at the same level as they were in 2019 before the crisis. Of course, along the crisis, the year, we saw some signs of trouble. Supply chain problems and shortages, increasing transport costs, commodity prices also went up. And after the summer, of course, we saw energy prices increasing, especially in Europe, with, of course, effects on inflation. Despite these headwinds, I would say, economies nevertheless predicted an economic growth for 2022. COFAS predicted a growth of 4%. This was, of course, slightly less than in 2021, but it was still quite high. Consensus then was that the inflation would gradually go down in Europe as energy prices would probably decrease after winter. And also the pressure on supply chains would become less severe down the year 2022. In fact, some believed we were preparing for the Roaring Twenties again, in analogy with the past century. But yeah, unfortunately, we all know what happened. Instead of the Roaring Twenties, it's although we revive a new Cold War, and we ended up with the biggest commodity crisis since World War II, and even higher energy prices, of course. So, since February 24th, the situation has strongly and quickly deteriorated with no real view on a solution on the short term. Negotiations are going on, but the question is if these are serious enough to come to an agreement. Demands from both parties still seem very far apart. So a consolidation and a freeze of the current situation seems more likely. But of course, if this is the case, we could go on for a long period of time. The conflict could go a long way. So, short word on the unprecedented sanctions against Russia. Europe and the US, of course, responded with harsh and severe sanctions. Not going to run through all these sanctions. You probably know them better than I do. But with the disconnection of some banks from the SWIFT system and export bans, the Russian economy is gradually cut off of the global economy, or at least marginalized. This will have long-term negative effects on the economy, of course. So the freezing of the Russian central bank's foreign exchange reserves and the US ban on financial transactions will put extra pressure on the ruble, as the central bank can't massively intervene. So higher rates and capital control won't be enough to stabilize the ruble, although for the moment it seems the case. So a recession for the Russian economy is not very hard to predict. We will see how much the decline will be. This week I saw, for instance, a Standard & Poor's study which predicts even a 22% slowdown. This is perhaps too hard, but 5 to 10% slowdown is more realistic. In fact, it depends on three things for the Russian economy. First, consumption. If the war drags on, we don't know what the Russian consumer will do. Will he start to worry and will he cut spending? Second, is the production eventually, the Russian production eventually going to halt or to stop as sanctions blocks some firms the access to imports, for instance, imports from the West. Aircraft business or the car industry will be affected. And third part, and the most important, is that the Russian it will depend on the Russian fossil fuel exports. So despite all these sanctions, Russia is still, for the moment, selling about 30 billion worth of oil a month to foreign buyers. This is all really it already went down because it's 1/4 or 25% of the pre-war exports. But they still have revenues, revenues which come also from the sale of natural gas and other petroleum products. So these are still flowing in, and this provides the Russians a valuable source of foreign currency. So then they can use them to buy goods from neutral or friendly countries. So these are the three things, depending on how the Russian economy will slow down. Of course, I presume it's not necessary, but I've put in the slide that Russian oil and gas are really essential for Europe also. We will see in the next slide that not all European countries are equally dependent on Russian oil and gas, but even the countries not importing a lot of Russian gas, like Belgium, for instance, are affected by the price increases, of course. On this slide, you see the dependence on the Russian oil and gas is really a European problem. You see that 83% of the gas exported of Russian gas is exported to Europe, and 46% of European gas imports are coming in from Russia. The US, for instance, is not a big importer, so their ban on Russian gas and oil is not really a game changer, of course. Like we saw on the previous slide, the Russian economy will take a severe blow, but beyond the gas and oil, Russia and Ukraine, of course, are very important producers of grains and metals. So with the war and the sanction, this will have an additional huge effect on prices, with consequences on inflation and the pressure on inflation, of course. So on the left of the slide, we see the part of Russia and Ukraine in global export of wheat, for instance. It's 25%, corn and barley. You probably also heard of the shortage of sunflower oil in our supermarkets, which also have an effect on the big users of this oil, like our famous Belgian fries producers. As Russia and Ukraine are also the biggest producers of sunflower seeds, of course. But it's not only grains. Russia has a prominent role as a metal trader, a metal supplier. So in the middle of the slide, you can see palladium, for instance, which is used in catalyzers in the automotive sector. You can see that nickel is also very important. This is used for instance, batteries, but it's also used in the production of stainless steel. And you can see other important metals which are coming from Russia. On the right side, you can see that Belarus and Russia also have a big share in global export of fertilizers. So 20% of all fertilizers. And for potash, their share is even 40%. You will certainly have read the articles that fertilizer producers have limited their production due to high energy prices and these prices of potash, for instance. So what do we see? Here we see that fears of the supply disruption increase commodity prices. On the left, you see that energy prices, the blue line, are now on the same level as they were in 2011. Yeah, 2011, between 2011 and 2014. Non-energy prices are far higher than in the past. So, and on the right hand, you see we carved out the evolutions in January, and you can see that clearly that the impact since the beginning of the conflict is enormous. Yesterday, Brent oil was at $111. Gas price was at 109 euros megawatt hour. This is also clearly under the peak from the beginning of March, but in fact the gas price is at this moment, normally at this moment, so it after winter, is at 20-25 euros. So prices are still very high. So, as you can see on this slide, inflation in advanced economies are extremely high. We expect the inflation to go even higher in the next months, and we also remember, of course, the comments of the chairman of the Fed, who talked first of transitory inflation. Then he left out transitory, he changed it to persistence, and now fears are that it may become even permanent. So when we take a look at Asia, and more particular at China, another event we need to take into account are the rising new COVID cases. In China, as you can see on the left of the slide. So after China still adopts a zero COVID policy, as you know. So this could cause supplementary supply chain problems. We see that in Shenzhen, which represents 2.7% of China's GDP. There are lockdowns. We see that Shenzhen, for instance, is a technology hub with headquarters of Huawei and Foxconn. But also Shanghai is now enforcing a two-stage lockdown. Shanghai is even bigger. It represents almost 4% of China's GDP. And of course, Shanghai hosts the world's busiest container port. So it's another possible cause of new supply chain disruptions. So on this slide, you can see the supply chain disruptions. The pressure on these global supply chain is increasing again after a first peak in COVID, as you can see. And after an easing at the end of 2021, well, it's even the peak is even higher now. On the right side, you can see that the PMI index is on a downward trend also. Then we come to an interesting slide, because in this slide we explain the increasing risk of stagflation. So on the left, you have in gray, you have a first initial shock, which increases commodity prices, supply chain disruptions, a so-called external shock. This has, of course, an effect on GDP growth, which we saw in COVID, but also inflation rises and corporate profits are going down as production costs increase. With decreasing profits, companies are reluctant to make investments, and the decrease of real income can also have an effect on GDP growth, of course, as consumption is going down with is coming down. So these effects, as we call it, they are in green. These are the first round effects. Now with this rising inflation, people are going to demand or request higher wages. And then we come into the second round effects. Higher wages have an impact on, again, company profits. Companies will increase prices, which will in turn fuel inflation again. And we have the famous price-wage spiral. To counter this growing inflation, central banks usually will increase interest rates with another effect on investment. So this double reaction of the first and the second round effects is in fact the explanation, or the textbook explanation of stagflation. So since the start of the conflict, we see household expectations of inflation rising, as you can see on the left. COFAS also reviewed its inflation forecast, as you can see on the right side. Yesterday, for instance, we received the new numbers for March for Belgium. We are currently at 8.31%, the highest since 1983, I think. And what we see now is that the energy part, which was fueling the inflation firsthand, that part is decreasing, and services and food are increasing their part in the inflation, and they are even currently higher than the energy part. So National Bank also wrote a survey. They expect now an average inflation for Belgium for the whole 2022 of 7.3%. So what we see is that the previous slide, the previous stagflation slide, is slowly but surely coming into effect. For instance, in Germany, inflation is now at 7.3. In February, it was 5.1. So this is also a big increase. So we are probably heading to double-figure inflation in Germany, or even in Belgium. So, needless to say that the economic growth in Europe will be strongly impacted. As you can see on the right, COFAS already reviewed its expectation. I will probably need to review it again. This is, of course, a downward review, as you can see. And if Russia stops gas exports to Europe, the Eurozone will lose 4 percent points. Of course, Russia will be hit even more, as we saw before. You can see what has a strong impact on the economic growth: lower private consumption, lower external trade due to the supply chain disruptions and Russian sanctions, and lower business investment. So COFAS already reviewed. I talked in the first slide or in the introduction of 4%, that COFAS predicted a 4% increase in 2022. Now we reviewed it to 2.8. If, of course, because we all know that Russia threatened to stop gas deliveries because it was not, it wanted to be paid in ruble. But of course, Europe refused. Now, apparently, yesterday the threat was withdrawn from Russia. But if it will be the case that natural gas would be cut off to Europe, this disruption would be, of course, very damaging. As you can see, natural gas is 20%, 25% even of the energy mix in Europe. And if you know that Russia delivers 40% of the natural gas, yeah, the impact is 10%. So on the right, you can see that especially Italy, Germany, and Latvia will be hurt, as they are very dependent of Russian gas. But of course, all countries will be impacted due to the price. So COFAS revised growth forecasts not only for Europe but for all over the world, and you can see that countries in red, of course, are most hurt. It's normally it's Russia, Ukraine, and in green you can see that there are just a few winners. Not surprisingly, the oil producers, of course. So when we come down to sectors, like I already said, all sectors are affected. There are cost pressures in agro-food. There are increasing risk of supply disruptions, leading grain traders suspended their operations in Ukraine. So there are high cereal prices, which lead to higher meat prices. Yesterday, in an article, 3 out of 10 food companies here in Belgium are considering lowering down or even closing down their production, because they want to avoid producing with a loss, of course. So yeah, of course, yeah, producers of wheat and cereals, some traders are winning, but further you go downstream, yeah, it's gonna be very difficult. So further sectors are suffering, trying to cope with the situation, like transport becoming affected by bans and higher fuel prices, but also the chemical industry sees as the cost inflation soar, higher prices with a squeeze in petrochemical industry, the fertilizers, of course, which I already mentioned before. And then, of course, there is a further blow for the automotive sector because of plant closures, because in the Ukraine several car makers are having a plant in Ukraine, and of course the shortages, supply shortages, but also the high material prices. So all sectors, in fact, are affected. As you can see in the next slide, given that the energy consumption, you can see the energy consumption of the sectors. So almost all sectors are impacted by higher energy prices, of course. This was the first part of the presentation on the macroeconomic situation. Now for an underwriting perspective, this part is a little bit shorter. First of all, I want to show you the evolution of our exposure in 2021. You can see that after the COVID dip, we gradually increased our exposure in 2021, and we arrived at the record high in February, at the end of February 2022. As you can see, the group COFAS exposure is now at 600 billion euros. So you see a gradual increase. Now, can I promise you that this increase will go on? No, of course not. Won't lie, because we don't know what's coming. What we see is that bankruptcies are going up. For the UK, for instance, the number is already higher than before COVID. For Belgium, the numbers are also going up, but still below pre-COVID numbers at the moment. So, of course, we need to fulfill our predictive role, but I can assure you we don't have any directives from the top from the group to reduce or cancel limits on a certain sector or subsector. Does this mean that we just leave it like that? No, of course not. What I can promise you is that we will have a case-by-case approach. What do I mean? So, as a credit insurer, we have access to a gigantic database of companies all around the world. And besides official available information, this database is also contains confidential information, of course. This information is collected and processed by 400 credit analysts all over the world. So what they do, they call or visit companies and ask about financing strategy, their market, how they are dealing with all these challenges mentioned before, and what, for instance, what solutions do they have for the price increases? Can they what pricing power do they have? Can they put their price increases to their clients? Do they produce their own energy or not? If not, what sort of energy contract do they have? So what's their position on the production chain? Because the further you go down the production chain, the less pricing power you have. Do they have enough supply, for instance? Can they find enough people? So what I can say is that our credit analysts for the moment are doing a lot of overtime, contacting companies all over the world, of course. Now, as an underwriter, we analyze all this macroeconomic information we have, of course, also the sector data, and of course the information I just mentioned coming from our credit analysts, and all this information we combine this with financial data, of course, of the companies, the debtors, possibly the group they belong to. And we also take into consideration the payment experience we have. And of course, we are in an open dialogue with our policy holders, because quality of service is still very important for us. Personal contact will be key and will continue to be a top priority, as it was during the last years, the last couple of years. So we want to accompany you, to support your business in these extremely uncertain and worrying times. So this was my presentation. Thank you for the attention. So if you have further questions, please put them in the chat. So we have a question about the expectation on the building market. Do you preview a lot of losses in construction business due to increased costs? So for construction, of course, it's extremely difficult if you have a project to anticipate all the price increases. So it's quite difficult to assess that and try not to build or go into a project with some losses. What I for the moment see is that the bigger construction companies are still doing fine and order books are still okay. For smaller companies, it's more difficult. I think I saw an article that only 1 out of 2 can process all the price increases to their clients. So if you ask me, do you think that there will be losses or that we foresee some claims in the construction sector, then I must say that I do. I really think in the construction sector it will be very difficult, especially for the smaller players. So second question is, do you see an increase in the number of claims or the size of the claims, or both? Yes, we can see an increase in claims by number, but also by amount. There are, of course, claims coming in on Russia and Ukraine. That's evident, but also on buyers working almost exclusively with Russia or the Ukraine. But not next to these levels, to these claims, we see several larger claims on yeah, good or even excellent buyers. If you know our DRA, we received some large claims on DRS 7s, but also on the DRA 9. So yes, we see an increase in claims by number and by amount. Are we already at pre-COVID levels? No, but we see a gradual growth. Another question is, do you think ECB will raise interest rates? Yeah, first of all, you see that the Fed announced what the Fed announced in the beginning of March. So, but in the US, so their inflation is not the same as the inflation in Europe. It's more internal, not so really coming from an external shock. So they announced 6 or 7 more hikes, I think, during 2022. So going up to 2%. What will ECB do? Of course, we expect that finally, after the tapering, ECB will have to increase the interest rates. Like I said on the slide of stagflation, yeah, the first shock for the European inflation was an external shock, the rise of the energy prices, but it's coming more. The second round's effects are coming, like the wages and so on. So eventually, ECB will have to raise the rates again. So I don't see any more questions. So yeah, then I think we can close. Thank you. I would like to thank you for your attendance, and hope to see you next time. So thank you very much. Bye.